Hi everybody, this is part 9 of the how to pass a QuickBooks certified user test, part of a 10-part series of topics. The whole video series is about 12 videos long because we have an introduction video, the 10 topics, and then the outro video where I talk about some tips and tricks on how to pass a certified user exam. On this one, we're going to talk about accounting basics. This is not very fun topic, but accounting basics are extremely important to understand QuickBooks and understand your role as a bookkeeper or an accountant. So the topics we'll cover our first section is what the basic financial statements are and have a basic understanding of what they all mean. We're also going to talk about some accounting principles, the difference between cash and accrual reports. We'll talk about setting up a closing date and protecting the books from being changed once all the adjustments have been made and the books have been closed. And finally, we'll talk about doing a journal entry and why is it important to understand debits and credits and accounting principles before going in there and actually entering a journal entry. However, if the accountant gives you a journal entry that tells you exactly what to do in terms of what accounts, debits, and credits, you don't need to know these principles. But I think knowing these principles is extremely important. So let's talk about first why a business exists. In accounting, this is called the concept of a going concern. Going concern is an assumption that we make that the business will continue to operate, carry on its objectives, and pay all of its obligations. Businesses do not need to make a profit, but most of the times the purpose of a business is to make a profit. A profitability is the capacity for a business to create internal value through its operations by generating more sales than expenses. Now, why does accounting exist? Well, there has to be a universal way for every business in the world, every business type, to have some sort of standard in which financial statements are prepared. How do we record every financial transaction using a standard in order to measure profitability and other concepts that we're going to talk about in every business. Now, not all businesses are operated by owners, so keep in mind that there's a lot of investors out there, such as the entire stock market, for example, that need to understand all these businesses they're investing into. And when they're looking at financial reports and financial measures, they want to make sure that profitability and other components of it are measured in a consistent manner. As a matter of fact, financial reports, in order for them to pass accounting standards, they must be reliable, they must be objective, they also must be consistent. So when you're looking at things year over year, you're looking at the same exact piece of information, and they have to be comparable. So they have to be so standard that when you're choosing between two companies, you could essentially compare what the two companies do through financial statements. Now, accounting is designed to record every transaction in a system called the double entry system or the balancing system. That means everything you record will be recorded in at least two ways in order for money coming in to be balanced with whatever that money coming in is supposed to mean, or money coming out is balanced with whatever that money coming out is used for. Okay, we'll talk about the double entry system more in a minute. Now let's talk about accounting principles. Accounting principles is a real boring part of the video. Accounting principles are the top 10, the top 9 things that accountants need to keep in mind when looking at a business. Accounting principles are the principles in which accountants abide by in order to prepare financial statements or do accounting for every business. And it's also the principle that is consistent throughout. Uh, and any accountant or all accountants will follow this. Number one, accounting principle number one, a business, it's an economic entity in itself. That means it is separate or independent from its owners. Extremely important concept. Number two, there has to be a monetary unit in which the economic activity is measured in. So we have to measure this in US dollars or euros or whatever. We can't measure them in rocks, right? So we have to measure them in some sort of consistent currency or monetary unit. The third principle is there's a time period element to it. That means we assume that the business can report financial statements in a monthly, quarterly, annual matter, and this time period is clearly stated. So when you're looking at these financial reports, you know you're looking at a year, a month's worth, whatever. The cost principle means that every single purchase that we make, it's evaluated at the price that it's originally paid for. We don't change the value of the things that we buy to some sort of market value or some current value or some other objective approach of measurement. Another accounting principle is there has to be full disclosure. That means that financial statements, when they're made public or given to an investor, a lender, a third party, we also have to add additional notes that disclose information, quote unquote, beyond the numbers, which means, if there's a lawsuit that's threatening that business capacity to exist, that stuff needs to be disclosed. Now, the going concern principle, which we talked about earlier, it means we assume that the business will continue to operate. We assume that the business is not going to close their stores next month, right? That's the purpose of reporting on a continuous business, on a business that is assumed to be going to stay alive in continuous days or months or years or whatever. The matching principle, probably the most important principle, the matching principle pretty much says that expenses need to match the sales related to those activities. This is also the pillar of the accrual basis of accounting, which we'll talk about a little bit later on. Accrual basis, extremely important concept. So matching principle, again, it means that if I have a bunch of expenses and a bunch of sales and they're related to each other, we report them in the same period. If I have some expenses that we really don't enjoy the fruit of its labors, or those expenses don't really apply to our current sales, and we're prepaying a bunch of things for next year, for example. On the matching principle, we don't count those as expenses yet. We move them to the next period in which the sales related to those expenses will start matching. Now, we also have the materiality principle, which means that in many ways, accounting it's making estimates of a lot of complex transactions and a large amount of transactions. So there are some transactions that are extremely small, that don't matter, that don't move the needle, that they're not going to change somebody's perception of the company if those are put or omitted in the financial statements. So materiality means that accountants must decide, what is a significant amount that will affect the financial statements, and accountants must report every single piece of material transaction or material value. Accountants are allowed to omit immaterial transactions or immaterial values. Ninth principle is conservatism. Conservatism means that accountants will take a conservative approach to recognizing income. That means that if there's a tiebreaker where accountant is not sure if that income should be recognized now or later, then the tiebreaker would be, let's be conservative, let's recognize it later. And the 10th principle, but not least, is revenue recognition. Revenue recognition means that we recognize sales or income when it's earned. So when a client calls you and says, "Hey, I want to buy $10,000 from you," and you say, "Yeah, sure, I'll ship it next week," we don't recognize that sale yet because we haven't earned it. Earning it means we actually do our part of the deal, which is shipping it to the client or giving it to the client. That's an example of revenue recognition. Now, back to the double entry accounting system. So the double entry accounting system means that because the principal subject matter is that we're measuring, it's money. And sometimes we also measure non-monetary assets, but we always measure them in their historical cost. And every single transaction that we make, whether it's a monetary or non-monetary, will affect at least two accounts. Now, accounts are different financial categories that fit into our financial statements. One of the two principal financial statements the profit and loss, and the balance sheet, which we'll speak about pretty briefly. Um, these accounts will be organized into these financial statements, and they're going to fall into one of these 8 categories. So there's eight possible categories in a financial statement, especially in a QuickBooks financial statement. Those 8 categories are going to be assets, liabilities, equity. Those three are part of the balance sheet, or income, cost of goods sold, expenses, other income, or other expenses. Those last 5 are part of the profit and loss or the income statement. Every transaction would have at least one debit and at least one credit. Just a quick in principle here, debits are used to increase the value of our assets and increase our expenses, where credits do the opposite. They would decrease our assets or decrease our expenses. Now, credits increase the value of our sales, liabilities, or equity, and consequently, debits would decrease sales, liabilities, and equity. A quick example is if I make a sale and I get paid and that money goes into the bank, that sale would be a credit. My credit is increasing, and the the bank part would be a debit because my bank balance, which is an asset, it's increasing. Okay, so that's the debit and the credit. Now, in QuickBooks, you don't have to worry about debits and credits unless you're specifically doing a journal entry, and then we'll talk about journal entries towards the end of this video, and we'll explain the concept of actually putting the debit and the credit into QuickBooks. Now let's talk about the financial statements. The first financial statement is called the income statement or the profit and loss. The profit and loss is a report that it's ultimately used to calculate net income. Net income is the last line on the financial statement. This is why they call it the bottom line. The bottom line is also a term that we use in language to cut to the chase and briefly tell you the end of a story. This is a financial term. This is where it comes from. In the profit and loss, what we really care about, the most important thing is the last number, the bottom line. This is the profit. Now, the profit and loss explains activities during a period of time or with a range of dates. So from date A to date B. So these are called in concept temporary values. That means that we can look at a profit and loss from last year, and then we look at one from this year. The stuff that we looked at last year no longer matters. It's lost in time. It's history. And we expect these numbers to change or vary over time. Now, the profit and loss tells the story on how the business operates in a day-to-day basis, such as what you sold and what expenses you had to pay for. Now, what are the components of the profit and loss? So let me switch over to QuickBooks real quick. So I have 2 financial statements open in QuickBooks right now. What I've done is I collapsed both of them. As a matter of fact, let me make the font a little bit bigger. That way we can appreciate those numbers a little bit more. So here on my right, I have my profit and loss, my balance sheet. And here on my left, I have my profit and loss. We're going to get started with our profit and loss. This section is not about manipulating reports. For that, you want to look at section 8. However, I have all the categories collapsed here, and you're going to see 2 major categories. We're going to see ordinary income and expense and other ordinary income and expense. For the time being, let's ignore that second one. That is just part of the extraordinary income and expense components of the business. We'll talk about that a little bit later on. So let me go ahead and expand all ordinary income and expenses. I'm going to go ahead and collapse the 3 major categories. Okay, there's 3 major categories. There's income. These are all my sales, my revenue, pretty much what the business does for a living, which is sell something, a service, a product. Then we have cost of goods sold. These are all our direct expenses. This was the cost of selling something or the cost of sales. Cost of goods sold, that's a great name. Cost of goods sold could be for products or it could be for services. It's still the name of the category of all the direct expenses. So the key component there, cost of goods sold, are direct expenses. Then we have the gross profit, which is the difference between our income and which is 100,000 in this case, and our cost of goods sold, which are 11,000. That is the difference. That's our gross profit. Now I can also turn on the percentage of income in the QuickBooks report, so we can see this represented, let me collapse this again. We can see this represented in margin. So our margin in this case is 88.7%. That means that for every dollar we sell, we keep 88.7 as profit for the business to spend in other ways, such as expenses. So expenses are the next category here. I'm going to go ahead and expand these. And expenses are the expenses that the business needs in order to stay alive. This is the overhead of the business. These are the general indirect expenses that are required to run and operate the business. Things like rent, utilities, your vehicle expenses, not the investment on the vehicle itself, but the actual gas and insurance and things like that. Payroll is another big component, office supplies, and then let me collapse this. And then at the very end, we have the net income. In this case, the net income is 74,000. But also, there are some components here that have nothing to do with the day-to-day operations. Like a miscellaneous income, like interest earned from a bank or something like that. That would be something not part of the operations, right? Or maybe interest you paid um, for the short-term need of capital. That's also not part of the operations, or maybe your taxes as a corporation, right? You put your taxes down there. So the key component is we really are 100% focused on is the net income all the way at the end, but the most important one is the ordinary income, which measures the main activities of the business. Let me go ahead and expand this report. Now we can see our fully expanded profit and loss. We have tons of categories. We can actually have multiple income accounts measuring different income components. We can have multiple cost of goods sold account also measuring multiple direct expenses. And then we can also have multiple expense accounts and sub accounts measuring things in multiple uh, dimensions. So that's the profit and loss in a nutshell. Okay, so back to the PowerPoint here. So sales are our revenues or income components. Cost of goods sold are direct expenses like the cost of the inventory we sold, direct job materials, subcontractors, basically every cost associated with making a sale. Now the gross profit is that difference between sales and cost of goods sold. And then whenever you see the word gross margin, is the same thing as the gross profit, but represented as a percentage of sales. Then the expenses, which we spoke about, these are the indirect expenses like rent, payroll, office supplies. And then the ones under the other category, quote unquote, other category, these are the extraordinary items that are not really part of the normal operations. And we want to separate them because we don't want somebody looking at these reports thinking that these other income and other expenses are always expected to be there. And then at the very end, we have the bottom line, which is the net income, which is the number that matters. This is what people refer to as the profit. This is, how much money we make at the end through our operations. This is how much value the business generates through its operations. Okay, so we spoke about the profit and loss. Now we're going to talk about the balance sheet. The profit and loss and the balance sheet are the two most important reports, financial reports in QuickBooks. Now, the balance sheet itself. In the balance sheet, the report, it's always used to calculate the accumulated value that the business owns and what the business owes. In other words, everything the business owns, everything that the business claims to own, and versus everything that other third parties claim against the business or what the business owes is ultimately the purpose of the balance sheet. Now, we want to ultimately arrive to the net worth or the equity. So we have the assets, which is what the business owns, and the liabilities, what the business owes, and the difference between the two would be the net worth or the equity. Now, the balance sheet explains the financial health of a business at a specific point in time, at a single point in time. Balance sheets always display as of one day, one specific day. It's not a range of dates, it's one specific date. Now, you could compare it this year versus last year. That could happen, but the balance sheet is supposed to accumulate all these values over time up to that specific date. That represents a snapshot. It's a snapshot at a single moment in time of the financial health of the business. Now, the balance sheet has accounts that are considered to have permanent value, which means that these accounts will accumulate, whether they increase or decrease over time, and they are measured from the inception of the business. So it's the inception of the business, every account that has accumulated value, whether increase or decrease, gets summarized or accumulated up to the day that the balance sheet is pulled, and that's the value that you see. The balance sheet is connected to the profit and loss via the net income. In other words, the net income, which is the bottom line of the profit and loss, will accumulate into the equity section or the net worth section of the balance sheet. Now let's talk about some of the components of the balance sheet. Let me go into QuickBooks real quick and show you a typical QuickBooks balance sheet. So what I've done is I collapsed all the accounts, and you can see two major groups. We see the assets, and then we see the liabilities and the equity. These two things must balance. That's why it's called a balance sheet. In a nutshell, everything that I own should be equal to everything that I owe and the difference between the two, which is my equity. Now I'm going to open up assets real quick. So I'm going to expand that, and I'm going to go ahead and collapse all the sub accounts and just leave it into two major categories of assets. We have our current assets, and then we also have our fixed assets. There's one more that's not showing here. Let me go ahead and just create a check real quick, and that way it accumulates something into that area of the balance sheet, and we can also see all three. So I should have something called an other asset. It's not created, so let me go ahead and create this, and I'm going to create a category, an other asset category, and then we'll call this goodwill or something like that. And I don't really want to get into the details of what goodwill is, but let's say a business purchased another business that was ongoing, and we booked it as goodwill. So I just wanted to kind of show you the three major categories of the asset portion of the balance sheet, which are going to be our current assets, a fixed assets, and our other assets. So the current assets, which is what we see here, this is going to be composed of everything that's either a cash or a cash equivalent or something of value that will likely to be turned into cash within an operating cycle, which is typically a year. Some businesses have a lot shorter operating cycles, but in a nutshell, anything of value that will probably be converted into cash somehow within the year, that would be a current asset. So what kind of things do you see there? Well, you see my checking and savings. So my bank, my cash on hand, all that stuff is going to be there. Now we see things like our accounts receivable. These are all the open invoices. Typically, we're not going to have invoices that are going to be paid more than a year from now. So we suspect invoices to be current or to flow and be converted to cash pretty soon. And then the other current assets, we have things like undeposited funds, which are customer payments that we received recently that we haven't made into the bank. Prepaid insurance, because typically we don't pay insurance more than a year in advance. Something like an employee loan or even a shareholder loan, and inventory. That's the typical things that we see under current assets. So those three are the components of current assets. Then the next one we have is fixed assets. Now under fixed assets, we're going to see things like a truck, a building, equipment, machinery. Fixed assets get depreciated. That means we buy them and record them at cost, and then we record the loss of value over time. That would be that depreciation. And then other assets, pretty much anything that doesn't fit current asset or fixed asset goes into other asset. I gave you the example of goodwill. Also something like business lending money to another business or to a person, and it's a long-term sort of loan, and you're not going to get that money back within the year. That would be a good place to put other asset. So back into we're going to go into the PowerPoint here. So this is the breakdown of the three types. So we have the current assets, the fixed assets, and the other assets. I typically just think of a current asset as something that is going to be exchanged or turned into cash within the year. It's part of the day-to-day operations. It's highly liquid. And then other assets would be the total opposite of that. It would be an asset that it's probably not too liquid, and it's probably not going to be liquidated or turned into cash within the year. And a fixed asset is something that you purchase, that it's used for the business to generate income, and we're going to depreciate it over time. So let's talk about liabilities, and we'll jump back into the QuickBooks report in a minute. So liabilities is what the business owes, is what third parties can claim against our business's cash or assets. Liabilities are the exact opposite of an asset. These are items of negative value to the business. Liabilities have two major categories. We have the current liabilities, just like in the asset side, same thing. Short-term debt, like a credit card, or accounts payable, like vendors that we're going to pay within 30 days or 60 days. Maybe a bank's line of credit. Those are good examples of current liabilities. And then long-term liabilities, those are good for mortgages or 5-year loans, things like that. So basically, two type of liabilities: something that I expect to pay off within an operating cycle, obviously a lot less than a year or less than a year, and then long-term liabilities, typically debts that are over a year. And then under that would be the equity. And remember, liabilities plus equity would add up to assets. So equity is the difference between assets and liabilities. And at the same time, consequently, equity is also the sum of the owner's capital, which is everything that the owner puts in the business, minus what they distribute or what they draw. Okay, that's the net of the owner's capital, plus all the net income that we don't distribute. Remember, that comes from the profit and loss statement, and that turns into something called retained earnings, which is basically all the net incomes that were not distributed over time. So looking back at the balance sheet here, I'm going to go ahead and collapse all the accounts and just open liabilities and equity. And typically liabilities and equity are looked at together because again, this is the counterbalance of the assets. So we'll start with liabilities, and we have some examples here. We have accounts payable, which is our vendors that give us credit to pay them over time. We have our credit cards, right? So the balance in a credit card, whether it's a positive balance means that we owe the credit card money, or a negative balance, which means we prepay the credit card ahead of time or something like that. Those are the typical things that we see there under current liabilities. We also see things like sales tax payable or payroll liabilities. Those are things that we're typically going to pay within a month or two. So it's definitely under that 1 year operating cycle that I was referring to. And then the long-term liabilities would be all the loans in which the entire principal is not due within the year. Now, most loans you do have to pay every month. So you could say, well, a long-term loan, even a mortgage, I pay a monthly, so that should be current liabilities. But no, it has to do with the entire balance being due within a year or more than a year. So if the entire balance of a loan or a liability or a debt of some sort, it's due within the year, then you're going to put it under current liabilities. If it's more than a year, you're going to put it under long-term liabilities. Let me go ahead here and open equity and just collapse here the liability portion. That way we're not even looking at that. So there should only be a few components of equity. You should see owner's equity, retained earnings, and net income. And by the way, retained earnings and net income are pretty much the same. This opening balance equity, it's kind of an error, something that QuickBooks creates in order to put opening balances somewhere whenever the user is creating new assets and things like that. So in order to just kind of hide it in there, I'm going to go ahead and get the opening balance equity account, and I'm going to just kind of bury it here under the owner's equity category. Now, I'm not saying that's what you should do, but just for the purposes of showing you a clean report, I'm going to go ahead and collapse all of our other accounts. So these are the only things that we should be seeing under equity. We should be seeing owner's equity or owner's capital and retained earnings. Those are the only two things that we should be looking at: owner's equity and retained earnings. Now, why do we see net income and retained earnings separated? Is because in QuickBooks, when you look at a current financial statement, something that's active from the current year, it's going to separate retained earnings and net income. But if I look at something that doesn't have any current information, I'm going to go to like the next year, for example, and I'm hoping there's no transactions there for the first January of the first year. Let me go ahead and collapse all these things. Hopefully, I'm not going to see any retained earnings. All right, perfect. I don't see any retained earnings because I'm just looking at the combination between net income and retained earnings. Let me just go back one day here and go to the current year just to show you. If we're going to scroll all the way down, we're going to see a combination between retained earnings and net income. If I were to add these two, it adds up to about 98,000. So if I go up one more day when it's not reporting anymore the current net income, we're going to see net income and retained earnings post together. That's part of the accounting closing, the traditional accounting closing system is when we actually move net incomes to retained earnings. However, QuickBooks does this automatically. All right, so let's go back to that concept that we spoke about in the beginning, where we were discussing why does a business exist. So a business exists pretty much almost all the time to turn a profit, to have profitability. Profitability is the capacity for a business to create internal value through its operations by generating more sales than expenses. It's basically being able to have more coming in than coming out. Ultimately, the owners of the business want to enjoy the fruits of their labor or their investment, and they're going to distribute these profits among all the owners. Only if the business is liquid. That means the business needs to have liquid capital in order to be able to distribute to them. So the business is not only measured by profitability, it's also measured by liquidity. Liquidity is the capacity for a business to pay all of its short-term loans or short-term obligations and still have some cash left over to operate. Okay, so that's pretty much liquidity. It's being able to have enough current assets to cover your current liabilities in technical terms. Now, solvency is a technical term for a business that's still in positive, still in the black. So if you, as long as you don't have more liabilities than assets, you would be a solvent business. An insolvent business is the definition of a bankrupt business. Basically means you have more debt than assets. You owe more than what you have. Now, it is possible for a company to be insolvent and still be able to operate because for whatever reason they still have some leftover cash that they can, you know, pay some short-term interest payments and things like that. But a company that's insolvent for too long, it's very unlikely for it to stay in business. So other than looking at the financial statements, income statement, profit and loss, and measuring profitability, which is part of the profit and loss. Profitability is going to be basically where you see if a company is profitable. That would be in the income statement or the profit and loss. But when you're looking at a balance sheet, which we were talking about earlier, we're talking about the balance sheet like the assets, the liabilities, and the equity. What we look in the balance sheet is to make sure the business is liquid and solvent. All right, we're going to shift gear a little bit to the concept of accrual basis versus cash basis. This is a very important concept. Before we get dig into it, let's just clarify a concept. Most households or individuals that balance their own checkbooks, uh, we tend to work on a cash basis. Basically, we see, oh, we got money coming in, and then we have money coming out, and that's a great thing. Okay, so that's typically how on a short dimension, how we look at accounting. We see it in cash basis. It means when we get paid, that's income. When we pay something, that's an expense. However, in the business world, we tend to have clients that we sell them stuff, but we don't get paid until a week, a month, a couple of months later. And at the same time, we have vendors or service providers or suppliers that also give us things that we buy from them without paying for it immediately. So there is a need to account for these things, and that's the concept of accrual basis. Now, most of the times we want to manage a business under accrual because we need to understand where we stand, not just based on how much money we have in the bank. We also need to know what's out there, what's coming, and when is it supposed to come, and what's about to go out, and what do I owe, what are my bills. and when do I have to pay those? That's all part of your cash flow management, and it's very difficult to measure that without accrual basis accounting. Now, don't confuse also the concept of being cash basis for the purpose of tax returns. It is possible for a business to file taxes as cash basis, but that still doesn't mean that you can manage the business in accounting, in accrual. I mean, yes, we're going to file as cash basis because we'll pay taxes based on the income that we got paid for and the expenses that we actually paid, but we'll still run and manage the business in accrual basis. Now, accrual basis wants to measure or focuses on measuring activities, not payments. Although in accrual basis, we also look at payments when we look at accounts receivable and accounts payable, but the focus really it's around understanding the activities of the business and the financial health as a result of the activities, not necessarily the payments. For example, if I sell an item on terms, which means that I sold something to a client and I gave them 30 days to pay, we still need to record the sale. We'll do a credit. We'll do credit to sales. And then we also have to record, because we have to balance the transaction, we have to record that liability the customer has to pay us, which is an asset to us called accounts receivable. We have an asset, the client has a liability, they need to pay us. We record that under accounts receivable. So we're going to debit accounts receivable, credit sales, debit accounts receivable. Now, these are basically for all the open invoices that we're keeping track of. Now, at the same time, let's say I incur an expense, like I buy some supplies from a vendor that gives me 15 days to pay. Now, I'm going to incur the expense, record it on the books, go ahead and record my debit as in the expense. So I'm going to debit my expense, and then I'm going to debit the record. Sorry, I'm going to record the credit to accounts payable. So I have to make sure that the debt itself, that the liability, right, the debt, the amount of money I need to pay to my supplier, let me make this bold here, the amount of money I have to pay to my supplier is recorded into a liability called accounts payable. So whenever I incur an expense, I debit the expense and I credit accounts payable or the liability. So that comes down to the concept of a journal entry. Okay, we talked about debits and credits and things like that. So before we dig into journal entries, let me kind of explain the accounting formula. So if you ever taken a basic accounting class, this is pretty much the first thing that they teach. Assets minus liabilities equals equity. Actually, they teach it a little bit different. They say assets equals liabilities plus equity. I find that a little bit confusing. I like to start with assets minus liabilities equals equity. The easiest way to explain is I own a house worth $500,000. That is my asset. I owe on the mortgage 300,000. That's my liability. 500 minus my 300,000 liability equals my equity, 200,000, which is what I can go and get a home equity loan against. So if you understand the concept of a home equity loan, is basically the difference between what I owe on it and the value of the house. Now, flipping the formula a little bit, this is how they teach in accounting class, because this is how the balance sheet is organized. We have assets in the top, liabilities and equity in the bottom. So when you add liabilities plus equity, that's supposed to balance with assets. So don't think so much about the formula, think about how these should balance each other. Now, when we think about debits and credits, because that's kind of one of the hardest thing for non-accountants to remember, what's when to debit an account and when to credit an account whenever we're dealing with doing a journal entry of some sort. So just think about the accounts that are on the left side, the assets. Left would be a debit account. That means that if you see if it's an asset and you want to increase the asset, that would be debit. And consequently, if you want to decrease the asset, that would be a credit. Now, the accounts on the right, liabilities and equity, those are credit accounts. That means that they are increased with credits and decrease with debits. But now to go a little bit deeper, let's break this formula down in a way that equity gets actually broken down and what it's supposed to mean. So we spoke about what equity meant, what the net worth meant. Equity has basically two components. It has the owner's capital, let's just call it the capital, plus the retained earnings, which is also the net income, the profit. So when you break down equity into net income plus owner's capital, the formula is now assets equals liabilities plus net income plus owner's capital. Now to break it down even further, what is net income, right? Again, net income is the same thing as retained earnings. What is net income? Net income is income minus expenses or sales minus expenses. So if you were to break down this formula even more, it would be assets equals liabilities plus income minus expenses plus owner's capital. Okay, so it will look like this. Assets equals liabilities plus income minus expenses plus capital. Again, because income minus expenses is the same thing as net income or retained earnings. Now, if we do a little math, you know that you can move anything across the equal sign from the left to the right simply by changing the sign. So if I move the negative expenses to the left, I'm basically going to turn it into a positive. So it's going to be expenses plus assets. So now it's going to be expenses plus assets equals liability plus income plus capital. So this should just make sense because this is just the way in math, the way you move things across the equal signs. But the reason why I did this exercise is to then tell you the ultimate debit and credit cheat sheet, which basically means if this formula makes sense to you, then all you have to remember is assets and expenses are my debit accounts. That means that they increase with debits and decrease with credits. And then the accounts on the right, liabilities, income, and capital, those are my credit accounts. That means that they increase through credits, decrease through debit. So I find that to be one of the best ways to learn the accounting formula and then learn at the very end or memorize, why a debit and a credit it's what it is or how it works that way. So let's move on to doing a journal entry. So now that we know based on the type of account that we're dealing with, what's a debit and what's a credit, let's talk about what a journal entry is. So a journal entry is when we need to make an adjustment to the value of an account because QuickBooks didn't calculate that desired amount that we were looking for or what the accountant was looking for in order to apply all the accounting principles we spoke about and apply the best knowledge about the business and evaluate or give the right value into one of the accounts on the balance sheet that's different than what QuickBooks is it's giving you, and requires the accountant or somebody that understands these concepts to adjust it. So we then create a journal entry, which is a debit or a credit into the accounts we're trying to adjust. Again, we use debits to increase the value of our assets and increase our expenses, and we use credits to decrease the value of our assets or our expenses, and then we use credits to increase our sales, liabilities, or equity, and debits to decrease our sales, liability, or equity. Now, at the end, debits and credits must balance. That means that we need to have integrity of the double entry accounting system, and QuickBooks won't let you do an unbalanced journal entry. So that's fine. You don't have to get too worried about the whole balancing concept. Now let's go and do a journal entry in QuickBooks. But before we do a journal entry, let's look at a financial statement. Let me look at a financial statement for this fiscal year. And let's say that for whatever reason, the accountant is looking at this and going through all the numbers and they detect an error. And let's just say, hypothetically speaking, the error is that this account here called payments on account really is, let's say, uh, an expense that we made into some special expense, let's say insurance, but we categorized it under payments on account by mistake. Now, this is a liability, and a liability at that at this time it's at a negative value, so we need to increase it to make it zero. Now, going back to our magic formula, liabilities are increased to credits. Okay, so in order to increase my liability from a negative number to a zero, I need to create a credit to payments on account and then create a debit to whatever the other account is supposed to be. Let's just say this happens to be insurance. So I'm going to go into company, click on make journal entry, and let me go ahead and make this a little bit smaller so I can see the number right there next to me. So I'm going to go to payments on account. So I basically select the account that I want to adjust, and a journal entry must have at least two accounts, right? Because that's what the entry is. You're adjusting from one account to the other. So I'm going to go ahead and credit this 1520. That's going to increase my liability from a negative number to a zero. And then my other side, which would be the debit, I'm going to go ahead and pick it here. Let's say that happens to be insurance expense. Again, don't worry about the correctness of this. Just this is the adjustment that my accountant determined that we have to do. So as long as I know what I'm supposed to credit and what I'm supposed to debit, I do the journal entry there, and then I'm going to hit save. And then what you see instantly on the report, that balance just disappeared. Matter of fact, in QuickBooks, I'm going to change the amount. Instead of making it 1520, let me make it 1521. That way we actually have a credit balance there of $1, so we can see it there more clearly. So I'm going to go ahead and hit save. And yes, we should now see $1 balance. So that's what journal entries do. Journal entries are used by accountants that apply all the accounting principles and all the best knowledge about accounting, and they debit and credit accounts to adjust their values and change their final results. Okay, so let's jump to the practice question here related to using QuickBooks and basic financial statements and basic accounting. Um, so question 17, when you run financial statements in QuickBooks, what bookkeeping basis can you use to view a report? Now, that's a part I didn't cover, so let me jump into QuickBooks and specifically talk about that. So regardless of whether you're a taxpayer that views things in an accrual or cash basis. Let me pull a profit and loss here. QuickBooks will tell you here in the top what the currently selected basis is. So right now, QuickBooks by default showed accrual basis. Now that's because I told QuickBooks to do accrual basis, and this is whether or not the company itself files accrual or cash for tax purposes. So if I click on the customize report button at the top, I can actually change the report basis to anything that I want on the fly. So I can change it here to cash, and I'm going to go ahead and hit OK, and that will change my report to cash basis. Notice that the numbers are now very different. And this doesn't mean I changed the accounting method. It doesn't mean that I'm stuck doing one or the other. It basically means that I have the choice to switch from cash to accrual. So going back to this question, it says when you run the financial statement, what basis can you use for the reports? And you have cash basis. That's one of the options. Accrual, yes, that's the other one. And then the right answer is C. You can actually the right answer is all of them, right? It could either be cash, it could be accrual, or you can switch to whatever you want. So the answer is C or D, but it's technically D because it could be any of them. Kind of a trick question. So you kind of think about that. So yeah, cash, accrual, or you can switch whichever you want. Now, what are the main two financial statements you can run in QuickBooks? So let me just jump into QuickBooks here real quick. And when I click on the reports menu, and then company and financial. This is where my main financial statements are. And notice that I have tons of options here. But the question is, which are my two main reports? So that's going to be profit and loss standard and balance sheet standard. Those are the two. So let's jump to the PowerPoint here. So my options are balance sheet and profit and loss. And then I have a whole bunch of options. Obviously, the right answer is A. So the right answer to this question is A. Perfect. And then last bonus question, and this goes all the way back to our explanation of all the expense categories, is what is the difference between cost of goods sold and expenses? So let's go through them. A, no difference. It's just the same concept said in different ways. So cost of goods sold and expenses are similar, but they're not the exact same. So A is definitely not it. B says cost of goods sold is the term used for direct and fixed expenses, and expenses are always variable. I think maybe it's really kind of the opposite. Let's see. I don't like that one. Let's go to C. Expenses are indirect and they're mostly fixed or manageable or predictable. So maybe they're talking about expenses that the management decides to spend or not, like payroll and rent. Obviously, you could choose whether you want a lot of staff or little staff or a big office or small office. So that's what they mean by manageable and predictable. So it's good so far. And cost of goods sold is for direct expenses that are mostly variable as a percentage of sales. And I did mention that cost of goods sold is supposed to move up and down as a proportion of sales. So C is looking great. D says expenses are for services, cost of goods sold are for goods. Well, that could make sense, but obviously it's not the right answer. The right answer is C. Expenses are indirect. That's a key component, indirect, and cost of goods sold are direct.